Hello, everyone, and thank you all for joining us during the Lytham Partners Fall 2022 Investor Conference. My name is Adam Lowensteiner, Vice President of Lytham Partners. During this presentation, we welcome Augmedix, ticker symbol of AUGX, that is Alpha Uniform Golf X-Ray on the NASDAQ Stock Exchange, and its Chief Executive Officer and Board Member, Manny Krakaris, and its Chief Financial Officer, Paul Ginocchio. Before we begin, for all those not familiar, Lytham Partners is one of the country's leading investor relation firms with more than 2 decades of corporate access experience. We've built one of the industry's most diverse and effective platforms for connecting small cap companies with high quality and focused institutional investors while creating a framework of best practices in all aspects of investor relations. Today's discussion is yet hopefully another example we can bring value to multiple constituents. We'll dive into the discussion in a moment, but one final item, I want to remind everyone that Augmedix is available for one-on-one meetings later this week. If you have not already signed up, please send me an email at lowensteiner@lythampartners.com or visit www.lythampartners.com/virtual and click the one-on-one meeting request button. With that said, let's begin. Manny, it's all yours.
Thank you, Adam, and thank you to our friends at Lytham Partners for inviting us into this year's conference. We're really excited to share our story with you. So let's get started and dive into the presentation. So I want to start by framing the issue here that we're trying to address. And the rise of the electronic health record in 2009, which was intended to convert paper documentation to an electronic form that would be much more transportable, had several unintended consequences. The EHR documentation burden has created a virtual wall between the physician and the patient. And as a result of the complexity of the electronic health record, physicians are spending way too much time every day on medical note documentation, and that's not why they went to medical school. This drives physician burnout, it lowers productivity, and it leads to suboptimal patient satisfaction. Our mission is to ensure the doctor sees the patient and not the technology. That allows physicians and patients to truly connect at the point of care. And our vision is to gather all available data and context during the patient encounter, put that expanded data into a machine-readable format, and thereby facilitate big data analysis to improve clinical outcomes for the wider population. Our products save clinicians up to 3 hours a day, which they can reinvest in seeing more patients or spending more time with their families. That reinvested time into seeing more patients drives revenue for the health system, and it also reduces employee attrition to the extent that they use that saved time for personal reasons and not work at night or during weekends. Here's a glimpse of the company's highlights. On the far right, you can see that we've grown revenue by 44% in the first half of this year, with $7.3 million of revenue in the second quarter alone. We have a virtuous business model that is driven by a land and expand strategy, which yielded a dollar-based net revenue retention rate of over 130% in the second quarter of this year. Year to date, we have landed a handful of new healthcare systems, including a top 10 health system and a marquee state university system. We complete more than 2.5 million medical notes each year, which feeds our AI and ML engines and makes our 500 plus condition models smarter, thus enhancing our operating efficiency. There are some key tailwinds in the industry that are accelerating adoption of our solution. First and foremost, the EHR documentation burden is leading to doctor and nurse burnout. And that's exacerbating the chronic personnel shortages that were plaguing the industry before the pandemic hit. Health systems are now using documentation services like Augmedix's as both a recruitment and retention tool. Second, there's increasing pressure on health systems to improve operating efficiency with the rise in Medicare and Medicaid patients and their lower reimbursement levels. Augmedix boosts productivity and enables their highest cost resource, their people, to function at the top of their license. And finally, the pandemic itself provided a window for virtual healthcare solutions such as ours to be validated and accepted by the industry. For those not familiar with our service, here's an overview of how it works. We provide doctors with a single-use smartphone or Google Glass unit that live streams the audio and video of the patient encounter via a HIPAA-compliant connection to the Augmedix ambient automation platform. Then, either in real time or asynchronously, depending on the solution that is subscribed to by the physician, our technology, assisted by a medical documentation specialist or MDS, turns the unfettered and ambient conversation into a comprehensive and accurate medical note. The completed medical note is then uploaded to the provider's electronic health record, such as Epic, Cerner, or Athena, for the doctor to review and sign off on. We have a large opportunity in front of us, which we estimate at over $6 billion. There are about 1.1 million practicing physicians in the US, and we conservatively believe that we can provide a compelling ROI to about 30% of them, or nearly 300,000 physicians. In the middle box, you can see we have about $1 billion revenue opportunity from our existing enterprise customers. We are less than 2% penetrated. There are more than 50,000 doctors who would strongly benefit from our service at our already contracted healthcare enterprise customer accounts. We've already achieved scale today with operation centers in 4 countries documenting 50,000 doctor-patient encounters each week and over 2.5 million medical notes generated every year. And that number is growing as we grow the number of doctors we serve. Here are the 3 products that we currently offer in the marketplace. We just launched our 3rd product this quarter, which gives us products for 3 distinct price segments in the market. By offering the broadest portfolio of products that can be delivered in the widest care settings in the market, we've been winning more than our fair share of competitive opportunities that we face. During our last earnings call, we announced that we're working on a self-service product. This product will be launched sometime in 2023. It will be fully automated and have strongly accretive gross margins because it is a pure software solution. I want to take a moment to describe our technology stack, which is presented in this slide. What you see in the light blue box is technology that we license from a third party. In this case, it's Google, the automatic speech recognition. We enhance it through machine learning that we glean from the 50,000 plus medical notes we deliver every week. Everything in dark blue is technology that we have developed in-house. So what happens is the ambient conversation comes into the platform. It goes through the automatic speech recognition module, which converts the audio into a long transcript, a literal transcript of what was discussed or conversed in the encounter between doctor and patient. Next, our natural language processing algorithms identify and classify all of the elements within that transcript that we believe are relevant for the medical note. Once those elements are identified and classified, they are uploaded to our note engine. Our note engine essentially is a decompiler. It breaks down each one of those elements into very granular details, which is, in essence, is metadata. And that structured information is then, it serves as the context for our builder manager, which is our automatic sentence generator, to create sentences that are accurate and meaningful and are uploaded into the relevant section of the medical note. Without that context, the builder manager would not be able to generate accurate sentences at the back end or sentences that had any relevance to the medical note. So it's really critical that we are able to generate this very granular information in order to generate accurate notes at the back end. In addition, the metadata, that structured data, we go through another step with that, and we ensure through our MDSs that it is labeled properly, because sometimes the metadata is incomplete or not perfectly accurate. So that's where the MDS comes in and labels that data accurately so that we have a set of very accurate, very granular data. Let me take a moment now to walk you through how the process of creating a medical note looks like. So here we see the conversation occurring between the doctor and the patient. It goes through the ASR model. And what you see in the second box to the right is certain elements or words within the transcript that is created after the audio passes through the ASR. They're identified, they're highlighted, and they get classified into certain relevant components of the medical note. Then those elements pass through our note engine, and that note engine basically asks a lot of very detailed questions about each one of those elements. So we have context from which our models can generate accurate notes at the back end in the medical note, as you can see the output on the far right. Our condition models, once that is completed, learn from this process and become increasingly accurate as more and more data runs through them. Here's a depiction of the landscape of the documentation market. There are two classes of solutions in the market today. One class, the legacy class, is dictation type services. And the other class, which is where the industry is evolving to, are ambient-based solutions. And the reason for the rise of ambient-based solutions is because dictation solutions were not providing the time savings or burden relief to physicians that the ambient solutions are able to generate. So these are the players, and you can see that within the ambient class of solutions, there are different types of solutions. There are remote solutions, and there are in-person solutions. There are also synchronous solutions and asynchronous solutions. As you can see from here, we are one of the few players that within the ambient marketplace that offers both synchronous and asynchronous solutions. And the reason why there are more players in the asynchronous segment of the market is because it is a much easier solution to deliver than a synchronous solution. Here's how we stack up against the different types of solutions proffered in the market. And you can see that we offer these various advantages relative to the other types of products, either dictation products, self-entry, or the asynchronous solutions or in-person solutions. Paul, can you take a moment and walk us through some of the financial highlights of the company?
Sure. This slide shows our revenue progression on the right and our gross profit development on the left, and our gross profit development on the right. We grew 42% in the most recent quarter, delivered 7.3 million in revenue when we guided to the third quarter sequential revenue growth. As we stated on our last call, we stated our sales cycle had shrunk from the first quarter into the second quarter. Our pipeline growth was accelerating, and that allowed us to have, both of those allowed us to have record bookings in June. We provided an update to the market about a week ago, stating that strong sales environment in the second quarter had continued into the third quarter through early September. We're excited about how this quarter has developed. As you can see on the right, our LTV to CAC is 5x with about a 14-month payback period. Those are very attractive metrics relative to benchmarks, and it gives us the right to continue to invest in sales and marketing and grow. As you can see on the bottom, we raised 40 million in October 21 when we uplisted to NASDAQ. And in May of 2022, we did a debt refinancing, which provided us an incremental $10 million of liquidity from Silicon Valley Bank. Both of those give us significant operating runway to execute a strategy. We stated we have over 2 years of operating runway based on our second quarter operating cash burn after CapEx. We also stated on the last call that we expect cash burn to decline into 2023. Manny?
Thanks, Paul. We've assembled a highly experienced management team. These members joined the company over the past 3 years, all bring unique skills and experience to the table. And the purpose of assembling such a strong team is to build a meaningful and lasting company in our industry. Well, we have a microcap company today. We have the elements in place to build a much larger company, and that is our goal. In summary, our product suite and flexible offerings have allowed us to win more than our fair share of competitive opportunities that we've faced. We help health systems see more patients by increasing physician productivity. We have a massive growth opportunity in front of us, over $1 billion in potential revenue from our existing clients, and this can be seen in our strong net revenue retention rate, which, as I mentioned earlier, was in excess of 130% in the second quarter of this year. We have compelling unit economics and are generating scale and operating leverage in our business model. And finally, our AI-driven platform will generate expanding gross margins and additional growth opportunities over time as we layer in an increasing number of pure software solutions. Thank you very much.
Thank you, Manny and Paul. Let's pivot a little bit to some questions. What problems in healthcare is Augmedix attempting to address? Is there any opportunity to alleviate labor shortages?
Absolutely, Adam. So today we know that the pandemic has exacerbated the gap between the supply of qualified people to provide care and the demand for care. Demand for care has been increasing, not just because of the pandemic, but because we have a growing and aging patient population. And so the dilemma that is faced by healthcare providers is, how do I do more with less? And relieving doctors of administrative tasks is one way to do that. And that's where we come in. We enable them to not have to deal with these administrative tasks, which consume a third of their day, so they can use that time to see more patients.
Can you talk about the three solutions you offer today, Augmedix Live, Augmedix Notes, and Augmedix Prep?
Certainly. So we started the company with our synchronous solution, which we call Live. That is a full service solution. It not only generates the medical note for the physician, but it provides ancillary services such as orders, referrals, care gap reminders, pre-charting incorporated within that service, and a few other things. And so it really is, in essence, like an extension of the care team for the physician. It is priced significantly higher than our other products. It is a premium service. We price it, our average ASP is about $2,500 per physician per month for that particular service. In the middle of 2020, we launched the asynchronous service, which we call Notes. That is a standalone note solution. There is no ancillary services that are tied to Notes. And that is priced at an ASP of about $1,500 per doctor per month. What we thought when we launched it, our expectation was that it would at some point cannibalize our Live business, but we have found after 1.5 years of experience that that has not happened. So we have concluded that it is serving a very distinct segment of the market. Finally, our Augmedix Prep product is one that we launched just a few weeks ago. And it was launched to address pain points at some of our largest enterprise customers. And the pain point they were trying to address is the amount of time that their staff, typically medical assistants or nurses, were spending in pre-populating the medical note to provide the physician, the attending physician, enough information to be properly prepared for each patient encounter. We felt that we could do something to address that pain point, and to do it without the need for us to actually prepare the medical note itself. It was really important for this product to be standalone, independent of either our live service or our note service. We've done just that with this product, and it is priced at a very different, distinct price point at around $300 per doctor per month. And the whole idea behind that is to use it to establish a broad beachhead, if you will, within these large enterprises from which we can upsell the higher value-added services that we also offer. And now we can go into an enterprise and offer a portfolio of solutions which no one else can match.
Regarding the investments you're making in sales and the impressive LTV and CAC, how do you think about those kinds of investments and balance them with cash burn? Maybe you can walk us through the assumptions underlying 2 years of cash burn.
Okay,
Sure.
Paul can answer the latter part, but you used the right word. It's a balancing act, because you don't want to spend more than what you have, and so, but you also don't want to leave opportunities to your competitors. Our view has been that the return we're getting from each invested dollar in sales and marketing is so high, with that LTV to CAC ratio being where it is at 5x plus, that it behooves us to continue to spend dollars in that area. We do so judiciously, obviously, but the returns are just too compelling to stop growth. We don't want to do that. And Paul can talk about our organic growth rate most recently, and what we see in the pipeline.
Right. So on our operating runway, we stated on the last call that we have over 2 years. We calculated that based on the $31 million of cash on our balance sheet plus the $10 million of incremental liquidity from our bank facilities, divided by our $4.7 million in cash burn after CapEx in the second quarter. Remember, we have stated that our cash burn will decline in 2023, so that runway is not static, and obviously we're feeling good about the trends. As Manny mentioned, we're generating strong growth in the 40% range, and the incremental profits on that growth are starting to have a positive impact on our operating leverage, and that's why we're talking about lower burn next year. We think you're going to start to see that in the numbers.
Right, and one thing that's really encouraging, just that leads us to that conclusion, is that if you look at the actual rate of growth of gross profit and compare that, historically over the last several quarters, compare that to the rate of growth of OpEx, the growth rate is actually higher of gross profit than it is for OpEx. So that's an encouraging leading indicator of what we expect will happen to the cash burn rate in 2023.
Hearing from some companies in the market that some of their sales cycles are elongated. Are you seeing this? Are you experiencing that? What is the sales environment currently like?
Well, we're actually very encouraged because our sales cycles have contracted over the last 12 months or so, which is a surprising event for us. So we're not seeing that, and we've heard that other areas within healthcare are experiencing elongated sales cycles. That has not been the case for us. So we've escaped that problem, and I think it's because our customers can no longer afford to do what they've continued to do. Mm-hmm. This is an essential service that they must have. And the ROI is so powerful, the payback so short for them, that it's just very difficult for them to justify not doing it. So we're seeing an acceleration of the decision-making process within these big enterprises.
How is the ROI calculated on your solutions?
Well, we look at the impact to WRVUs, which is a standard unit of measure of a doctor's performance in the industry. And we look at the delta of the WRVU after implementation of our service for that particular physician. So we do it on an individual physician basis, and then we aggregate it across the physicians that are subscribing to the service. The WRVUs are translated into revenue dollars based on a formula that's unique to each enterprise, and they don't disclose that. We know what it happens to be for our various enterprises, but we can tell what the impact is from a dollar perspective when those WRVUs are converted into dollars. The impact and I can just cite a study that we did, a very large study across multiple specialties and primary care physicians, where the $3 million that they spent on our service over a 12-month period generated $7.1 million of incremental revenue for that enterprise, for those doctors. And it was well over 100 doctors that participated in the study. So it's a very compelling ROI and quite easy for us to measure based on their data, our customers' data.
And we're just measuring direct revenue generated by those physicians, not even some of the downstream revenue. So there are some even bigger downstream benefits that the health systems gain.
Right. By seeing more patients, they can funnel more, more for integrated health systems. They can funnel more business to some of their other departments. We didn't measure any of that impact.
How does the relationship with Google work?
Great question. So it's a multifaceted relationship. It started on the technology side with the Google Glass unit. It has evolved to licensing of their ASR, which we believe is the best in the industry, and we use it in our technology stack, as I described earlier. And most recently, excuse me, it has evolved to being integrated into their cloud sales infrastructure. So they have a 1,000-person team of salespeople that sell their cloud services to their customers. We are part of the solution set that team sells. We entered a formal contract with them to memorialize that partnership a month ago, and it has already yielded significant wins for us in the marketplace from customers, existing customers of Google. One of the hidden benefits of that arrangement is that customers that are within the Google Cloud ecosystem, if you will, they have to make dollar commitments in terms of how much of Google services they will acquire during a particular year. And they can use those committed dollars towards the purchase of our service, which is what is being done. So that what that means for us is that it removes a significant friction point in the sales process, the budget process. That has already been taken care of by Google. So we no longer have to address that with those Google clients that are brought into us by Google.
Microsoft and Oracle both recently entered the market with Nuance and Cerner. What are your thoughts about competing with Microsoft and other tech companies entering the healthcare space?
Well, Microsoft's a gigantic company. Oracle's a gigantic company. We're just a gnat in their universe. The one positive thing I think Microsoft's acquisition of Nuance has brought is a greater attention or focus in the industry of the need for this solution. Microsoft would not be getting into this business if it did not represent a very substantial opportunity for them. And so they've shed light on that, the massiveness of this opportunity. And in their view, that opportunity is much larger than the $6 billion TAM that we've estimated. So we welcome the competition. We are obviously very mindful of what they do, but we have the advantage of being a lot more nimble and flexible, and it's reflected in our win rates. We are winning a lot of head-to-head competitions against Microsoft's Nuance product because it is very singular. It's an asynchronous product. We have a broader range of solutions that we can offer, a portfolio suite of solutions, if you will, to our enterprise customers. And so we like the positioning we have today relative to Nuance. Now, with respect to Oracle and its decision to acquire Cerner, that is a different dynamic. But I think at the end of the day, what both Microsoft and Oracle are really anxious to get access to is clinical data. And Nuance represents a fantastic source of that clinical data for Microsoft. And Cerner represents a really good source of that clinical data for Oracle. We happen to be another independent source of that clinical data. So we kind of like how we're positioned, and we're one of the very few companies that have been able to penetrate the largest US healthcare systems.
Your gross margin had a nice upward progression for the last few years, but it's been stable this year. Why is that, and what's the long-term outlook for gross margins?
Sure. We service our clinicians out of the US, India, and Bangladesh. We have had more doctors. We've won a lot more doctors this year who are serviced out of the US. So while our gross margins of each individual country are the same, our mix has changed, which has held back our gross margin a little bit this year. We've had some good news, and we continue to work. We traditionally work with health systems in the US and over time migrate them to either Bangladesh or India, and that continues to be the case. And we are looking, we have some good progress being made there for some of our US business. The longer term outlook for our gross margins is unchanged. We are continue to believe our live gross margin will be in the range of 50 to 55%. Our notes gross margin will be in the range of 55 to 60%. And we have talked about some new products like Augmedix Prep, and the self-serve product will have even higher SaaS gross margins. So we continue to feel very strongly and excited about our gross margin profile going forward.
Manny and Paul, anything else you want to add today before we end the discussion?
Well, look, we're, as I just mentioned the last response that I had to you, we're really excited about this industry. Even though healthcare is facing some headwinds today in general, the need for our solutions has never been higher, never been more clear to the industry. And our positioning within the industry is really, really strong. And that's reflected in the accelerating growth rate we've been experiencing this year as we win more and more of our fair share of the market relative to our competition. So we're really excited about what lies ahead for us.
Thank you, Manny and Paul, for doing this and taking the time out to conduct this pre-record. We really appreciate it. To anyone out there who's not already signed up for a one-on-one, again, please send me an email, lowensteiner@lythampartners.com, or again, visit www.lythampartners.com/virtual and click the one-on-one meeting request button. We hope you all enjoy the conference, and thank you for attending.
Thanks, Adam.
Thank you for your interest. Thank you.